1, 2.
I'm going to start with this table over here. So what we will do is we'll put up each canvas, and I'll just ask the team to explain, first of all, what they worked on, and what are some of the key elements they captured that they thought were particular insights, and how that actually business works today.
Okay, so we took general insurance. We've got homeowners as our typical customer segment there. So we're looking at general insurance with home insurance as an example of that. So our customer segments there are homeowners, landlords, tenants, and so on. So we spent a bit of time discussing what the scope of this was. I think this is one of the things that we learnt, is that we needed to understand the scope. So were we looking at this from the view of an insurance business and customer servicing, or were we looking at this as a slightly deeper level and seeing the customer servicing as the background to asset management and managing the funds, the premiums that were being held? So we sort of shifted towards more of the customer servicing model and just understanding that. But it gave us some insight into how to use these within certain scopes, and how you could take different scopes and examine them on the business canvas. So we broke this down into a number of things which you recognise. So in our key partners, we've got regulators and mortgage providers who require their borrowers to have insurance, loss adjusters, the law of the land, which requires people to be insured for their motor vehicles and so on. The value propositions, things like peace of mind and reinstatement of loss and meeting obligations, and trust and confidence we saw as the value propositions here. And then we've got traditional activities here: fraud management, claims handling, customer retention, risk profiling, pricing, and so on.
So we thought about, for example, flooded communities and the difficulties they're having now getting adequate insurance, and whether or not you could take proper social groups in the sort of old sense of the word, people who really know each other, and replacing the current channel of brokers or aggregators, and finding a way to directly establish a relationship with the insurance company that may enable it to remove some or reduce the scale of some back office operations like fraud prevention and things like this, because there's more of a social imperative to not defraud the other members of your group. It was just a kind of a way to reduce the back office costs, I guess, and also to at the moment, the insurance company is not really making any money on the insurance activity. People who are making money are the middlemen, and perhaps in this model they may not be part of the equation.
And what did you find when you looked at the mechanics? So which are the bits that make this model work today that are particularly stable?
Okay, well, I think we started off by looking at the model for the industry at the moment. We couldn't restrain ourselves from kind of speculating about alternative models, and then we started to test some of the mechanics against the alternative models, such as the sort of group model that we used. So we discovered that in some respects the existing model is very strong. So for example, in the switching costs, although they're quite low, there's a high degree of inertia. But we identified that as long as the value proposition holds, then that will encourage that makes the switching costs appear larger. Although in practice, the cost of switching annual insurance is very low. Recurring revenue we have, and earn before you spend. It's kind of risk-based, so yes, you can't be insured unless you've paid a premium, but as soon as you're insured, you can make a claim, so you're entitled to. We found that there are strengths and weaknesses across the model at the moment.
So one of the things that we discussed here was, even though there's many different groups of customers that you have, they can, because of the way they perceive the value proposition, basically they be classified roughly in two categories. One which is people who choose to be insured and people who are forced to be insured. And depending on which group you belong to, how you address it with what, your value proposition, your partners and so forth, will be slightly different. And this may be something that is valid across the industry, I don't know, but this was the general segmentation, if you wish, that you can look at. And then within each of these categories, look at different types of products. One of the things that is not used a lot as well, looking at the cost structures, I think we got to the conclusion that this is a cost-driven business, right? And at the moment, there is no yet, serious exploiting of the fact that you can do cross-selling. So transform it into a economies of scope business. So there is very little cross-selling of products that happens by the insurance company itself. So these were the other couple of elements that came in the discussion. Yeah? Good? Super. Who's number two? You guys?
So what we have mapped up here is household direct. Primarily again. So the initial model that we've put down is remarkably similar to the previous one, which is reassuring that I think we both agree on what insurance is. Nice place to start. We have we looked at some of the different customer segments, and we came out with a lot of similar things. So you've got homeowners versus perhaps contents-only situations where you might be tenants, students, various niches like that. And one of the things that did come out of that is that I think the insurance industry tends to or can rely on segmenting customers by underwriting classifications rather than actually having a customer-led marketing like segmentation approach. So they're risk profiles, they're not actually segments. Anyone with a marketing degree would wince if I called high net worth thatched roof a segment. It might be it's an underwriting classification, but that tends to have been the way that historically the industry has worked. We have a number of similar themes that have already been covered. We pulled out some things in the partner side, for example, supply chain within claims. So actually in household, a large amount of all of your claims fulfillment is really outsourced provision. We just connect you to the building network, for example. But having something in there like that is always an interesting question, because if that's part of the value chain, if we don't own it at the moment, could we? Is it possible to monetize any aspect of that? Is a challenge we should ask ourselves. Similarly for the distribution side, where a lot of the distribution is actually controlled by a few software houses, or the people who get my price onto the Compare the Meerkat, for those of you who are not the industry insiders. So again, that was quite an interesting way of we had a real then good conversation around why is this model really predicated on a 12-month contract. Some of it's historical for underwriting reasons, because and premium calculations and that sort of thing. But actually a lot of the reasons why it's a 12-month contract seem to the old-fashioned IT constraints. So the aggregators are set up to say, we're quoting you against all of these prices, they're all going to be standard 12-month contracts. The software houses are set up to deploy rates that are all based on them being 12-month contracts. There's about 15 other examples of this, aren't there, Jeff? I think you noted some of them down. But every time we went through that one, why does it have to be like that? And is that an opportunity to then disrupt it by paying something else? And it's really potentially a double-edged sword, because the 12-month contract is nice because it gives you a certain degree of recurring income, even for 12 months. Would that be increased or decreased by putting people on a 30-day rolling equivalent for it? I don't know, but it'd be an interesting thing to explore.
Great. Super.
So one of the questions that we did raise is one of the things that would probably factor into, say, some of your switching costs and the quality of the customer proposition is, can I see all of my different insurance products, if it's buildings, its contents, legal expenses, motor, all of these things in one place and deal with those transactions in one go. Now, there are some people in the industry who've started doing that if you bought all of those products with the same company, which is great, locks you into a brand, but are there opportunities for a service out there that allows you to consolidate all of your insurance products? So you might have 3 of them with Aviva and the other ones with Allianz. Can I see all of those in one place? And if you could control that, is that a valuable customer proposition? I don't know. It was. I think there are some people in Australia who are looking at equivalents for that. Perhaps not in insurance, but Frank, maybe.
Yeah, I know. Recently, in terms of receiving bills, so gas and electricity, they have the system called BPay, and so the banks have signed up to that. I can say, look, I want to receive all my BPay bills, regardless of where they're coming from, into my online portal. I want reminders. I want to, automatically pay certain amounts, and it's a sort of consolidation of your views across your bills. And also, I started thinking about in the brokers. Surely, from a client relationship point of view, is we go to a broker and they go and get a number of policies from different companies. They must have a single view from the client point of view about what policies they've got, what's expiring. For the management of the client, well, why hasn't that been extended out into the client itself, or even in combination between the client and the broker, instead of it sort of being an invisible sort of view?
So it led to a bit of an interesting conversation around, is that really a big fundamental part of the service that a broker is providing in some situations? And for some of the more niche brokers, the ones who offer a personal service, it seemed like it was an element of it. For the volume ones, people like the AA and QuickFit, really it isn't, but it could be an opportunity to reduce some of the value the broker provides if you could or compete with them directly.
So if the banking industry is any judge for this kind of changes, probably consolidated view of accounts was one of the first things that started being disrupted. So where you started seeing startups coming in, right? All of the different tools out there that allowed you to configure an online portal that sucked basically or connected on your behalf to your banking products in order to provide a single view of accounts. That was one of the earliest, startups that started popping up all over the place. Yeah.
I mean, one of the areas that I think that seems to be would be an issue with that is claims, because even within the broker models, a lot of them they would have a load of that data. It's all together, and then when you have a claim, it's off to the insurer rather than we'll actually know anything or deal with you.
Thank you.
Who does the baton go to?
Okay, so we did high value insurance. I think the easiest way to think of it is Lloyd's, basically. So marine insurance, manufacturing plants, that kind of thing. So I was going to start with the customer first. The kind of things we're looking for are massively complex insurance. So oil, minerals, transportation, production, and liability for big public spaces, those kind of things. They all tend to go through Lloyd's because of the size of them as well as the particular expertise of that market. Okay. A lot of this is very similar to the others. Like everyone has, claims departments, risk departments, accounting departments. So I'll just point out the little differences. I think is particular to Lloyd's. When it comes to how you reach out to your customers, Lloyd's is still an old boy network. It's about who you know and the relationships you have. There's not an awful lot has changed in 100 years or 200 years of that. And the reason for that is really the only way to get to your market predominantly is through these brokers. So if you want to take on that risk, you have to go through brokers to get it. A lot of the times as the person taking that risk, you will actually not know your customer. It's all through brokers. The bigger companies you may go direct through, like the Coca-Colas of the world, but in fact a lot of the times they insure themselves anyway. All right? But mainly your main access to customers is through brokers. And let's see, some of the other things that were a little different. So again, people point out income is all premium and investment returns. That's basically how you make all of your money. And most of your money goes back out again in claims. So it depends on the kind of area, but around, you can think about 90% of your money will go straight back out the door in a claim, and a few more percent will go back out on other expenses. And that brought us to a conversation of, a lot of people are thinking of how do we make insurance companies more efficient. We could bring in technology to make back ends better and that. But at the end of the day, you're probably only going to affect, You know, if you make something 1% more efficient, it's 1% of 4% of their costs. So it's not the biggest opportunity out there. We talked as well about, in this particular industry as well, a lot of it is around the relationships you have with the third parties. So if a boat, a large cargo ship crashes off the coast of some country, you've got to have some local expertise there. You've got to have the ability to reach out to people like salvage companies and those kind of things. And while that might sometimes go out to external parties, so the better insurers will have those networks themselves. Okay, and that can be a big differentiator for you. Because the thing to remember is that companies, you might think, oh, I'm insured, does it really matter if this goes on for 3 weeks or a week? Well, it matters a lot actually, because companies, for branding reasons, for relationship with their customers, they want to be making money from their business, not from their insurer. Okay. The biggest thing here, I think, on hard things to get into is you've got to have a lot of capital, and you've got to be able to scale quickly. So there's very few of these guys who don't, have a couple of people. They're all big companies. What else? I'm just through things. Switching costs, we thought, I'll just go through these things, it's easy. So switching costs is pretty easy, actually. Okay, there's relationships there, but technically it's pretty easy to switch. Recurring revenue and earn before you spend are the reasons that all insurance models are great. Money, you always have to get a premium in before you can pay a claim. And it happens every year or monthly or whatever, so that's great money. Cost structures I touched on there about sometimes insurance industry, it's not the biggest thing. Getting others to do the work. We talked about, again, in claims, we talked about people going out self-assessment tools, taking photographs and sending in those photographs, and how that can save costs. Scalability, it's a brilliantly scalable business, especially in Lloyd's, where if you're a member of Lloyd's, you can do business anywhere in the world, basically. So there's no need to go out and get licensed in every country. So if you can do it for London, you can do it for Brazil. Okay. And protection from competition, again, a reason the insurance industry is a good industry to be in. So much regulation, you need so much capital sitting in the bank. You don't get these scrappy little startups starting insurance companies. No.
The only immediate threat to the Lloyd's type model is what's happening in the banking world and the securitization type play. So in the end, the possibility of putting huge portfolios of these large risks together and bundling it up and knocking out 10% to Allianz in a large bond, which is then tradable in the secondary market, it is the biggest threat to the big ticket insurers, because as the data gets better, the knowledge of what they make and what they return gets better and better, and at some point the big asset managers and the big capital providers can use their capital and compete with the people who provide insurance capital. It's coming.
Just Ryan, one quick. Well, that's very similar to the entry into the banking market by non-banks. Those with huge amounts of capital are going to do the same thing, or trying to do the same thing. It's very, very similar.
Sorry, but the only ones who can do it are Willis and Aon and Marsh, because they have a sort of 50% market share combined with these, and they have the spread of business, and they have geographic and spread by class. So they are getting ready to put together these things of risks that come to them, and then knock them out as securities.
Right. Okay. Okay. Well, thank you very much. That table number 4.
Okay, so we were looking at life insurance, particularly protection in the UK market. Quite a lot of the things that have already come up, we already flagged. But if I start from the end. Our customers primarily were purchasers of the policies, but also the beneficiaries. So life insurance is basically you die, your family gets a payout. So the beneficiaries of those policies are customers as well as the purchaser. We've also got intermediaries in there, and they pop up quite a number of times. I'll probably pick out just some of the things that were different to some of the other models, if that's all right, to save on repetition. I think we've talked about peace of mind and value for money, but this section in the middle. What it was now. So our value proposition is predominantly cash and transfer of risk, and it's really quite a simple model. Life insurance is quite a simple premise. It's not a particularly complex business model, and when we come on to talk about mechanics, that came out loud and clear that actually there are some immovable things in the industry and in our sort of line of work that is quite difficult to change, but also quite simple. There are a whole host of things up there in key activities which kind of add to the cost to serve, if you like. So key amongst those are, our claims management function, and that's everything from paying out claims to looking at fraud, looking at customer feedback, our underwriting and pricing capability. So a lot of that stuff's come up already. In terms of our key partners, there are a number of people here, but our reinsurers are one. We also have medical practitioners, so GPs and clinicians who actually help in our underwriting process. Intermediaries, again, our PR function, and suppliers of some of our third-party services. So it's quite a key one for us. If I can come back to customer relationship, this one was quite important for us because we felt actually we didn't really get much out of here, but this is probably where we felt most of the innovation could come from, because it's really important to have a decent relationship with your customer and also with your medical practitioners to help through the application process. But actually we felt that's probably an area that's quite lacking. So when we come to talk about that this afternoon, that will probably be quite interesting. In terms of cost structures, payment to beneficiary, capital requirements, advertising, marketing, management, distribution, sales, all the things that consume cash. And I can't read your writing, Dylan, at the end, I'm sorry. That's the investment. Yeah, so there are our things under revenue stream, so investment return and premium. So all in all, quite a simple model, to be honest, with some extras up here that add to the cost to serve. In terms of mechanics, unless you've got anything to add before I go on to mechanics. Have I missed anything dramatic?
I think the one small thing that I'd learnt, which I wasn't aware of, is that most life insurance is fixed-term life insurance. You're working at Barclays and they happen to throw life insurance in, or you insure your house and it's for that period of the mortgage, as opposed to I'm insuring my entire life. So.
And that actually helps with mechanics. So, on one side, the switch costs are actually, it's quite easy for customers to switch, and there's actually not many things preventing them from switching, so that's actually not great for us. But, there's recurring revenue, it's life of policy, so it's a constant recurring revenue stream. Premiums received up front, so in terms of that earning before spending, that's again works in our favour. Fixed costs are really high, so I mentioned that here. There are a number of things in terms of infrastructure and internal capabilities that are required in order to service that demand. In terms of getting the others to do the work, there's a little bit of that goes on here, so in the application process, but that could be really improved. But there's some evidence of that we could do more. In terms of scalability, that's probably, again, been already mentioned, but barriers to entry and scalability, there's lots of things that make it really hard from a regulation perspective for new entrants to come in and scale up really quickly, and the cost to enter the market's really high because of all the capability that you need. And in terms of protection from competition, again, capital requirements are really high, internal capability and infrastructure demand are high. And actually, this sparked quite a lot of discussion for us, but the opportunities to really innovate, to reduce premiums and really drive demand in the market, and actually it feels quite difficult. So that's another thing that probably protects the life insurance business from lots of competition, because it's not hugely attractive, it's not a sexy industry for people to come in and try and make money quickly. It takes a long period and a lot of investment up front. Okay.
I need to introduce you to the patterns, and that's when we can start innovating some of these models. We'll both look at the disruptors we know, but also we'll just look at the model as it is at the moment and say, how can you improve it, really?